Good evening. I'm Dan Hussey with Zaner Ag Hedge, bringing you our strategy of the week update here for May 11th, 2023. Apologies, we couldn't get to it earlier. Had a bit of a scheduling conflict, and then lo and behold, here we are after the open. But had to get this video out here. Not much to, well, there is some updates, but not much that we're going to have to Okay, so let's begin today by reminding everybody that trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But if you do want to get in contact with me, 312-277-0110. Find me Twitter, Facebook, or shoot me an email, dhussey@zaner.com. You can see those and info in that scrolling text in the bottom right-hand corner of this video. And of course, always check out our Zaner Daily Newsletter or the Strategy of the Week webinar here. Sign up for either one of those in the comment and information section of this video. Um, beans. Got cotton up in front of us. Take a little bit of a look at that, but let's bring up a daily chart here of July soybeans. There we go. Yesterday, yesterday's price action, which is kind of still today, but yesterday's price action was pretty bearish to begin with, and then we closed the day back above that $14 area, back above this downward sloping trend or upward sloping trend line against the lows. Was that capitulation? We came down to a new low here beyond the what was the low that day? Let's just call it 1383 and a half lower. Rather, we came down to test that area, did not break below it. So it kind of made like a double bottom there. We have another double bottom on the chart that's worth, kind of pointing out here in December corn. Maybe still flirting with that area. You could call it almost a triple bottom too there. But either way, July soybeans back above that area and back above 14. This kind of looks like a little bit of a stop hunt. Still kind of a neutral daily stochastic RSI coming out of oversold conditions. Do not love that we broke back below that 10-day moving average, but it's this 18-day moving average that's the real indicator of the trend for me anyway. And I'd love to see a cross back over that 10-day back. The 18-day is a short-term cross I've been using a little bit more and more as an indicator as we're coming out of some of these sideways markets. Right, my job as a trend trader, or if I identify myself as that, if I see sideways choppy markets, I need to identify what are some signals and opportunities that might signal that we're coming out of that. Well, obviously below low ends of ranges, above the highs, those are some we can talk about. Right below $14 seems technically significant here. If we really stay below there at this point, you got to be aware there's these long candles and whipsaws at this area that can be head fakes, but the day we see us close red down into that area, that might be the confirmation, right? And then we'll look for sell signals in rallies, or reasons to be a seller intraday in rallies. Back above 18-day moving average, right? It could be a signal for reversal. Cross over the 10 to 18-day moving average could be a signal of reversal for a move back higher, reversion to the mean in the larger time frame. Is what we're getting at. 200-day and 55-day moving averages up there around 157 for the 55-day, 159 for that 200-day, and the 100-day up at 1479. I still kind of expect this market, while we're above $14, to get back towards those levels and even back up to highs. I'm not going to be sitting here calling for $17 soybeans and the July contract without some other signals. If we saw gangbuster exports and had a late plant and all these other reasons, we would have a narrative driving that, but we don't. All we've had is pretty good weather, actually in a very aggressive plant for the places that have started. And I thought we would see us plateau, and those places that got an early start would finish, and the rest of the country would be playing catch up. But turns out we're seeming like things are going to get going. North Dakota still really hasn't, but okay, the Minnesota, South Dakota kind of are, and okay, acres are going to get in. Now that leads us, into a WASDE tomorrow where, we know that the planting intentions is the acreage they're going to be using. We know that trend yield is the yield they're going to be probably pushing out there. I don't see why they would do otherwise. There are going to be adjustments to that domestic consumption. There's going to be adjustments to our ending stocks and carryouts from last year. There's going to be adjustments to potential exports because we are, commitments aren't there relative to next year in corn and beans, or last year, I should say. Um, so, but when we were a dollar higher on soybeans a month ago, and the dollar was higher in value relative to foreign currencies at that same time, I think we had a different situation in terms of export markets, right? We were not as attractive, but now that we've shaved off a dollar, Brazilian soybeans aren't at a $2 discount anymore to our soybeans. We just saw a flash sale today for soybeans. If Brazilian beans are at such a steep discount, what the heck is China doing buying U.S. beans this morning? Now, I know there's some rumors that that could have been part of the corn cancellations from last week. They needed to shift to beans. The only reason for those corn cancellations, apparently, word on the street and from people more, what do you call it, knowledgeable of the information than I am, those corn cancellations could have come just because they needed the cargo space for beans. But again, if you need the cargo space from beans, why do you need that if you've got such record production out of South America and we're so comfortable buying that, right? So I don't know, something doesn't add up. Something hasn't added up for the last couple months. I mean, don't get me wrong. I think whacking the weather premiums and the premiums we built out in this market that maybe arguably printed, finding it and bouncing an old crop. New crop soybeans here, and we'll get to the 4-hour chart here just in a minute. New crop soybeans, still finding a low, but had that bit of a capitulation today below that 1250 area. Kind of closed back up in it. At this point, I don't know. Like I almost wanted to see it go down to test $12 just to like make a new low and really capitulate. And maybe tomorrow's news we do that. But I mean, we're just staying above this old resistance at 12 that we broke out of. Came back down and tested support once. Couldn't break out of resistance before. Testing 1250 as support again. I mean, I'm finding it hard to not look at November beans and just say, you know, we might kind of like last year. In fact, if you look at November, we're going to have to look at this another time because I don't have the chart prepared and I want to do this justice. But I'm fairly certain I can go back and look at Novi beans of last year. Oh my gosh. Who do I have to pay to get a trend line on this chart right now? There we go. I was trying to draw up this kind of trend triangle or maybe sideways price action that I see developing. And I do think that there's, a range and maybe a reversion to the mean, which, by the way, the 200-day moving average for Novi beans is up at 1350. I mean, we're talking 90-cent rally just to back to like the average price for the last 200 days. And I think we could get there, and I think we should be above $13, for soybeans. I don't, with the carryout we see, there's a lot. Let's just say that bag of seed is one of the best yielding bag of seeds we've ever seen. And we haven't even put it in the ground in some places. So anyway, there's a lot of premium that can still be built back into the market now that we've kind of whacked it all out, right? Like we went back to July of last year's prices and saying, okay, should we be up here? Should we have been beans in the teens? Well, I think we're going to scurry back up above those levels if we are. Reversion to the mean and test this old kind of area of support around 1320 as resistance. It happened once before. I could see us come back there again, and then that kind of sets up this range that we're in between 1250 and 1350 for a little while. I'm looking for more range bound price action here until it's not, but nevertheless we'll see what happens here. I'm optimistic that after and through tomorrow's report, I'm not so certain what the USDA can say to really make things more bearish than they already are. So I feel like once we get this report out of the way, we're going to really just start hyper focusing on weather markets. And, given that weather markets have been just about as good as they can look, I know with drought mats and whatever. I mean, the 7 to 10 day and 18-day forecast and 16-day forecast. I'm talking about those. Like, we see really good weather, right? Whether those come to fruition is another story, right? And we are in an El Nino year, and a lot of things can happen. So, all right, that's 10 minutes on the daily charts of the beans that I did not want to waste, but let's take a look at the 4-hour chart here for July beans, see what front month beans are doing, and see if this down, trend from the last couple of days is really over, right? Because we had a nice snapback reversal yesterday. would start to reverse things. It's intraday wise and what we're seeing. 50% retracement from the 1446 high down to the lows of 1485. It's the high to low for the month of May so far. That's at 1416. So I mean, I really want to see us get back to 1420 to 1422 to hit that 618 line, and then that kind of just continues to confirm that this is a 1450 to 1390, $14 ish range. Yes, we walked under 1385, but that's what I call capitulation. So if we don't really come back down here at all, and we just go pretty much right back up, okay, cool. That's it. That will be. I could consider that a low. If we do continue to slide right back below $14, back below this trend line, back below these lows, 1385, the open gap at 1351. I got to go out to a daily chart one more time so you can see that again here. There it is. This open gap over here from July at 1350-ish. Yeah, that would be the next, stopping point to the downside. And then, below there, you're talking about summertime lows around $13. We're talking about old crop beans, no longer being in the teens. That's a lot that I really struggle with that with a below 300 million bushel carry out. I just don't know how we can't price or why we're not starting to price ration a little bit more. Particularly if we're starting to see, flash sales. If the flash sales we saw today become a regular thing, if we start to see upticks in the export numbers, this market will go bonkers because it means everything we're afraid of, or everything we're rumoring and talking about down in Brazil about them not being able to get beans out, what have you, or even the talk of how big of a crop that was, right? China is still coming and buying from us in that, in that scenario. What does that tell you, right? Like, it means I think the export market is a little more better off than we think. All right, going down to a 15-minute chart here. It's actually hourly chart. It's a little bit better. I don't want that. Let's see what happens. I didn't want to see us get up to 16 here. Got pretty close. Market did pull back there though. Came within a penny there of 13.99, the 50% long. So let's see which side of this market kind of wins out here, 14.22 or 13.90, whoever kind of breaks first. These are not hard lines in the sand, people. This is just, I'm trying to point out there's a little bit of a fight over the trend and a little bit of a range happening, and there's a way of picturing this with 50 fibs sometimes. So I am kind of looking for the market, and arguably, I don't know if you'd constitute this a gap, or not, but the open and close doesn't align there. We've had some funky price action the last few days. I think getting back up to 1432 isn't out of the question in this market. It's just a range, and I wouldn't be surprised if we traded both sides of it with news tomorrow. All right, let's move on to corn, and then we'll get into wheat. Got a little bit to say about cattle. Crude's been a range. I mean, a lot of repeating of what we've been talking about for a long time here. Unfortunately, because it's sideways markets, right? And things are sometimes there isn't a ton to report. Corn, July corn, hate July corn below $6. Looks pretty bearish when you consider. We're back below the 10-day moving average. Can't even get for a test of the 18-day at 596, 55-day at 614, 100-day up at 635, and 200-day up at 650. Those are all a long ways off at this point. But reversion to the means back to any of those levels, I don't think is out of the question either. There's a downward sloping kind of channel going on right now. There's also an upward sloping trend line that we broke below, somewhere around this $6 area that we're kind of flagging below. So in the near term, I think it's very important that July corn kind of get its act together and push back above $6. If it can't do that and get back above this old trend line, this looks like the confirmation of a market that's about to kind of you hate to say it, but puke, and trading and trying to hold old support now as resistance. So maybe the capitulation has not happened yet for corn. I definitely think if we see carryout tighten up tomorrow, it could surprise this market, because I think a lot of analysts are expecting us to have found more corn or what have you, and cancellations and whatever always put that kind of taste in people's mouth. So we shall see. But this is from an LA wave standpoint, this is, a completed three-wave cycles down in A, maybe up in B, and down in like a jaggedy C leg, something. Either way, we did make a new low below that 575 area, and that is a somewhat significant um, thing at this point. But, you break further down and you get back into this 550 area. And certainly if this is all, one giant fib from highs to lows, well, we'll look at that on the other chart here. But let's hop into December corn real quick. December corn, definitely a level that has, the zone at 540. We came back up to test this resistance, and we're still kind of below it. December corn doesn't look like we've finished capitulating. I thought we might have had the bounce. We got back above that 10-day. Needed to see us kind of get back above the 18-day to feel like there's some confirmation and the trend might, be reversing, and we just get battered right back down to lows. Could it be kind of a double bottom down here? Maybe, but I don't know. We're no longer oversold. We got room on the chart to go lower. I think it almost feels like into tomorrow's report, we might see that dive to 5 and below. This might be the final capitulation as we see the biggest production number out of corn for the year from a USDA report. We set a benchmark for the most bearish look on acreage because we know the acreage numbers from our last month came from intentions, and I don't think we're going to get bigger than that intended acres this year. And then, trend yield is not that it's unattainable, but it's just, everyone knows how it is, right? Like this time of year, it's so hard to, it's very, let's just say, right, like any option market, you got to build in risk premium, and there's a risk that we're not going to get to trend yield, right? So, but it will give us some kind of, idea of, in terms of what to expect, right, in supply and demand, and then how we will, discount those balance sheets going forward, and then, of course, how that affects, price is the last piece of the puzzle, right? So we shall see. But major moment of, capitulation if it wants to happen, right? Like the chart is set up for it, is what I'm saying, and I would. At this point, I'm not surprised, and almost surprised it hasn't dipped below $5, excuse me, in December corn. Not that I want to see it happen, nor does it need to. It's just we've come this far. I feel like on a news event, on a WASD, where we're going to see them print, a big production number or something, like it makes for a good reason to find a low. At least in the near term, and then see some short covering. Is it the lowest low? Will it be the lows for the year? That, remains to be seen. Certainly if the picture turns and the narrative changes, that can always, affect things. But for right now, I think that the technical chart has room to go, which, is, something we got to be a little aware of here. All right, the small time frame. For July corn, going down to a 4-hour chart. Yesterday's reversal, it just put us back into an inside day of this outside day after a gap lower, just weird price action. This is just chop. We're holding above 580, can't break above $6. This is a 20-cent range. There is just no reason to really go into it any more detail than that. Fib it up all you want, but this is just 20 cents up and down. There's no one in between. We go below 580, go below lows. Yeah, right. There's markets breaking down. But back above 6 changes things. 610 could be resisted. 620 could, whatever. But that really changes things. I think that puts us back into the idea that we're in, one of these type moves. It doesn't have to go straight up. But, we come off of lows, we kind of in this 20-cent range for a bit, and then all of a sudden we go higher. And, okay, we reverse pretty hard from that 646 high or whatever. Okay, made another top and reversed hard then. But you see the point here, right, is that there's a clear line in the sand, and we hold it here, and we turn higher and go above 6. it looks very much like a reversal happening, and there's a lot of other signals that could be pointing to that. Otherwise, right now, it's just kind of a bear pennant. And with news tomorrow, you got to expect the potential, or expect this market to have the potential to, whipsaw lower or even spike lower before reversing, if it's going to reverse, right? We could just keep trending lower. I mean, the trend's lower until it's not. I think it had every ability to reverse that trend on this move and hold this last, week and a half up, and it's just not doing it. And I'm hoping that once we get this WASD out of the way, things will change. Full 50% short off the high, 647 last swing, high to low. Here comes in at 608. That's kind of the figure to break. And the full 50% swing from 705 highs down to the lows, 636. So, I feel like a move back up into that area, if you could see, kind of came back up, coming back up into 630, 640 would be the next, kind of move for this market as it moves lower anyway, unless we get really, 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 really bearish from here, which I guess it's possible. You know, but there's just so many things that, are standing in the way. Chicago wheat up 4.5 cents right now. Whether or not it stays up 4.5 cents is the $1 million question. Really been a dog the last, several months, but the pullback we're seeing is not that bad. I mean, yeah, we're giving back a good chunk and almost back, 50% and almost back to 618 lines off that low, but we're struggling, to break and holding resistance at the 18-day. But okay, we're out of and back down to $6. We're right in the middle of that stochastic. Kind of looks like a channel lower. Lost a lot of momentum down here, and every single one of these pops, seems to have some kind of follow through. Yes, sometimes we go down and test the low again, but we still come back up after each one of those strong moves off the lows. There's at some point there is another attempt. There isn't usually just one off of a new low. But it's a trend lower until it's not. We're below that 18-day moving average. We're below the levels we began the Ukrainian conflict at. But something is, off here because we're at a $2.11 premium in the KC wheat. And KC wheat never pushed down as far as Chicago. And if anything, KC wheat's in this like kind of expanding ending structure, in my opinion. If it doesn't just break down really hard from here, this market's retraced almost the entire sell-off. For like, this is the start of the year. KC wheat is actually positive on the year right now. July wheat. Well, I take that back. Almost. It was almost positive. It got to get back to 860. But we're almost positive on the year, right? When you put that into perspective of where we are at Chicago wheat back on January 1st at 782, we're $1.50 lower in Chicago wheat since the start of the year. So since January 1st, Chicago wheat has fallen $1.50 more than KC wheat. It's just, why? Right? Like, why? That is crazy. All right. I mean, there's a lot of reasons, but like, you get where I'm going with that. KC wheat flagging up at highs here. 844 cannot break below 840s. Chicago wheat can't break above 640. It's just like two totally different looking charts right now. Don't even know. Right? I mean, they're two very different wheats, but nevertheless, going to talk about them kind of differently here. KC wheat, I'm a buyer in the dip. I don't even know if it's going to give me a dip down to 815, 820. I almost think like you just kind of gotta get long here and maybe own. When markets get really aggressive like this and are flagged up at highs, you can buy them and put stops below like the low end of the range. That's fine. I prefer to get long the futures and then have like a put down here, like a put protection as my stop. Because how many times will you see this go, like tick through stops and then run higher? You either wait for that and kind of get in, or if you're going to have to be long here for the move higher, stops below 830 maybe. But honestly, I would look to maybe try to own the 830 put through the end of the week. Not a bad, thing to consider. Real quick as just a fun little look just to see what that's going to cost to protect a long and this would just be like get long, July futures here at 844, and you basically have 14 cents of risk to the put, um, which if we pull up end of week, yeah, we're gonna have to go out to next week. You can't just do it through the end to tomorrow. I mean, you could, but like, come on. Ooh, it's a little more expensive than I thought. Oh no, it's not. It's 10 cents, but you could get this done for about 10, maybe 12. It's called 12 cents. All right, now we're talking about 30 cents of risk to there. I don't know. Maybe not. Maybe it just makes sense to just buy or put a stop down at 814. I don't know. Okay, so if I'm not in love with that proposition, what's an 860 call going for? There you go. That's what you do. If you're going to go spend the money, go buy the 860 call for 9 to 15 cents. Get it done for 11 and a half if that happens. So, okay, instead of doing a synthetic call there, I'd say maybe just go and do the actual call. We go through highs of this week. It goes in the money, and you can own that for about 11 and a half cents right now. There's your finite risk into a report tomorrow. But maybe the best thing to do is actually look for like an 860 call, and you bid maybe 5 cents for it and hope for that dip. That's an interesting proposition. But anyway, wheat into tomorrow, I think has a pretty good opportunity here to prove itself if it wants to. Chicago wheat 4-hour chart talked about that full 50% long off of lows, 636 area. That's still the support. Resistance is clearly coming in at the 670. That's that old resistance, old support now is resistance area. Kind of the old range lows, if you will, that we broke below, come up and tested as resistance now, right? Full 50% retracement from the 735 swing high to low comes in at 770 now. So this fortunately still looks like a market that's making 2 steps down, 1 step up, 2 steps down, 1 step up. 2 steps down would take you down to 572, maybe as low as 520 in an extension. But hey, while we're above $6, while we're above 620, it looks like a little bit of a range here. And hey, above yesterday's highs at 640, I do think it short covers back to 660. And then now you're talking about putting pressure on the resistance. And if it gets back above 670, you're back into the old range. And then you don't really have much to $7 to 735, the old highs of that old range. And then, now you're talking about going through old downward sloping trend lines above $7. Now you're talking about really reversing the whole downtrend. And now you almost have a different narrative going on for the technical chart for wheat. KC wheat, as I mentioned, we kind of already looked at maybe the small time frame there. Bull flag here up at 840. I mean, it's hard. It's hard not to say. I'm bullish. I'm bullish above 830 and not bearish below. But okay, below 830, we could go down to test $8 again. I'd be considering, being a buyer. And I would not be shocked at all to see wheat do a big whipsaw tomorrow. 20, 30 cents before, going considerably higher here. And I think for the KC wheat, the way I would maybe try to do that and catch that drip or that dip is like look for call options that you could pick up cheaper. Put a wish order out there on the 820 call, the weekly call. It says it traded for 30 cents last. Okay, yeah, well, it's in the money, obviously. But let's just say we go down to $8. Well, an 820 call is going to be 20 cents out of the money at that time. What's the 865 call going for? Well, it's going for about 10 cents right now. So that means that 30-cent call, if we go down to $8, might be only worth, the call that was worth 30 cents, the 820 call, may only be worth 10 cents at that, or, maybe going for about 10 cents at that point. So, sorry I didn't bring these up. We're looking at these prices here. But point being is, right, put in a wish order for that 820 call at 10 cents to buy it if it goes down there or something. Other, more than one ways to take that risk if you think that's what is going to happen. And hey, that's what that's what I'm here to discuss with you. All the different ways to get the exposure you need and want. Real quickly, here, bean meal is just an abysmal looking chart, which is kind of weird because canola and canola, excuse me, and palm oil are look a little different than this chart right now. But maybe a rounding bottom. This 50 figure seems to be technically significant in the near term. So let's see if we can put in a fitting our footing there. Meal reversing, I think, is the swing and been the challenger here for the beans. So meal coming off of their lows, getting back above this 430 area is technically significant, and putting pressure back to 440 gets you back in that old range. So it opens the door back to 460 and the old highs there. And a meal-driven rally, I think, would be interesting. It looks like a big two steps forward, or up and then one step back. One step is not indicative of the wave structure, right? This looks like 5 waves up and then 3 waves back in a correction for meal. So I'm anticipating, if that bottom finds a place, well, let's see what happens. I did think a big reason the oil chart has gotten a little whacked here is crude oil itself. The crude selling off 3-day sell-off, now lower lows and lower highs. Okay, well, maybe full 50% retracements, off of the low here could come into play. Look for support around 68 to 69 there. 68 is, of course, the old larger 50% area, so it's kind of like a retest of that big 50 on the daily charts as well. I don't love that from the swing highs here from the April high down to the May low. 73.50 is your 50% short, and boy, we just rallied right up into that. The swing short could take you down towards the 58 area if it goes there. But above 75 just continues to confirm. Crude might be in this 82 because we do go, if you get back above these old get back above the 74 area, we call into question this old resistance at 82, and then, we're just kind of basically back into the 72 to 82 range. So, yeah, I think crude is trying to maybe, be in the lower end of that $20 range, but we go back above 74, there's not much that's going to keep you, in my opinion, from 84 again. So, and then above there, brings you back up into this kind of 80 to 100 uncharted territory that summertime months with the demand for oil that we see there. I feel like it's looming, but I don't know. All right, live cattle, real quick. So I got to get to bed, guys. I got a silly 1-year-old who just started walking, and I spent my entire evening chasing him around the house, which is, I'm not complaining. I love the kid. It's awesome. Live cattle open gap, maybe still down here at 156. Came down, did not close that gap at 161. I think we got to have a push down there at this point. This rally up, if we didn't, get back to highs, we're fading. We're back still below that 18-day moving average at 163. I think we're going to roll back over, fill this gap, and then genuinely, head back down to the 156 and test that 200-day upward sloping trend lines, all the good stuff, big channel, whatever. 158 to 156. I'll be happy with the pullback on this chart. For the time being. So kind of anticipating that happening. Not much going on in the 4-hour charts there for the live cattle inside, this range price action below the 10-day and 18-day moving average. I think we test 161. I think the 55-day gives way, and we're probably down to test the 200-day moving average, around 157 at that point, okay? Lean hogs just can't get a bid. It is bearish market. It's down until it's not. Not much going on there either. Feeders weakness into the end of the day might have been a false breakout, and if we reverse lower there, watching September feeders below 228, I think we could slip back down to new lows for the month. And gold and silver. Gold, yeah, plenty of support below us here. This 1937 area will be interesting. 1940, 1950. There's an upward sloping trend line right around there, and that would be the next in series long if it gets down there. It's also this old high that we're breaking out of, and old downward sloping trend line that now is old support, now is resistance, or resistance now is support. The old high 80 to 20. That's the big breakout. The secondary at 2650 for gold. It continues this. Does not mean we can't pull back to 1850, 1800, what have you. I would, say that a dip in the bullion is probably one to think about buying, but the move that, generally speaking, I was expecting into this, first 2 quarters of this year has kind of run its course. So now I'm worried that we might be due for a pullback. The 30-year note, though, doesn't seem to be confirming that, putting pressure on the 131 area. A move above 133s here, I think, for the 30-year will help gold get above its highs there into the $2,100 area. And that would, I think, mean gold's going to right 23 to 2,600. I think the 30-year at that point would be on a rally back to 145 to 154. We would see a massive hit to U.S. rates. As I think it kind of justifiably needs to happen at this point. Just a short covering rally. I mean, this market got real short on the way down, and then has been continually selling into this, fearful of the Fed continuing to raise rates. And it wasn't until like March of this year where we started being worried about recessions, and the market is just, kind of not responded. Right? The Fed just raised another half basis point. I don't see this market trending lower. Rates up means that this should be down, and that's not what's happening. We're very content above the 130 handle. In anticipate it more than the breakout above the highs at this point, but we shall see what happens there. And last but not least today, the S&P 500. Really not much to talk about. Very similar to the bonds there. This kind of sideways price action at resistance. This big old circle on the chart was where I came out and said I think the rest of this year is going to be one of a move that kind of goes like this and goes doo 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 doo. But basically will get us up to 4,800. Not by the end of this year, but we'll be in the midst of a bull trend. And so far, the only thing that hasn't happened is a break above 4,200, and I think that's the key move here that I feel like this market's trying to do. It's an outside month so far. May has a wider range than April. It certainly gets very bearish below the lows of the month at this point. Could break down to 3,800, what have you, but above 4,200 opens the door. 4,300 and 4,400 would be your next stopping points. Okay, it's only 100 points higher. Thanks, Dan, for that obvious statement. But for real, those would be significant levels because they're taking out 6 to 8 lines of the entire swing from 4,800 current all-time highs down to the lows. After that, you would, genuinely speaking, 4,200 is the 50% area. The shorts are there participating. They give way above 4,300. They start to cover. They panic. They get out, and they admit they're wrong. And and then you get everybody else rushing in, what have you. And by the way, this is all happening, right? 2 quarters ago, 6 months ago, end of last year, was the low in the stock market. So if the recession's now, 2 quarters ago is when we bottom. Just statistically speaking, 4 to 8 months, I guess they say, stock market. You don't believe me, go Google it. But statistically speaking, 4 to 8 months before economic recession is showing or called for or talked about, right, you already have a bottom in the stock market. And there's a lot of reasons for that we could talk about. But it's not a huge deal because it is what it is. So, all right, everybody, I'm off to bed. It's going to be a long day tomorrow and an interesting day for price action for the row crops. I'm not throwing in my hat yet. I do feel as a bull, I've gotten, my teeth kicked in, my eyes battered, and smacked around here. And right, I'm not a bull, screaming that you have to be bullish. I'm bullish because the longer time frame still has tight prospects for tight carryouts, and the narrative for being very, very bearish is I don't know. I don't think we need to panic too much. That, however, does not mean whatever subsequent rally we see here does not warrant a great opportunity to get sales done. On the contrary, these are very volatile markets. Every rally you should think about doing the cash sales. I will show you plenty of options to get reownership done and to put that risk back on the board. And I don't want anybody to think that, right, you're going to miss out on those opportunities. I have these discussions with clients a lot, and there is a psychological element to trading that, right, the FOMO effect that we don't, the fear of missing out, so to speak. You don't want to, in being a commodity producer, you can't afford to miss out on those opportunities either, right? But if you're going to try to and take risk, you need to do so right with finite risk on the table. Um, and there's multiple ways that myself or a member of my team or any market strategist worth a grain of salt can help you uncover. So, all right. Have a great day, everybody. We'll see where the WASD leaves us into tomorrow and through tomorrow's report. Remember, if you ever want to get in touch with me over here at Zaner, 312-277-0110. That's my direct line. You can find me at Daniel Hussey Jr. here on Twitter, Dan SOT on Facebook, dhussey@zaner.com. Always love the conversations. Shoot me your questions, comments, leave your likes and your information and any questions you might have in the comment section below. I'm going to go get to bed to be woken up here in just a few hours by my toddler of a son. Uh, the joys of being a young parent. Love the kid, but man, gotta let mom and dad sleep, huh? All right. Anyway, have a great day, everybody, and we will be back with you tomorrow and as price action develops. Take care, everyone.